guys, I'm Daphne Quay, your Boss Lady Realtor, and today we are doing this video with my good friend Alejandro Juarez, who is a local Austin lender.
Hi everybody.
And he's awesome, he's really good. You may have noticed he's been in a bunch of my videos because he is so full of information. We're going to be talking about FHA loans and VA loans, what they are, what all is required. We're gonna just get into the nuances and go over as much information as we can.
Perfect.
Leave a comment, ask any questions that you might have about these types of loans, whether it's this one or just anything in the home buying process in general. We are more than happy to help.
Absolutely.
Ready?
I'm ready.
Okay, let's go. The first loan type that we are going to be talking about today is FHA loans. What is an FHA loan?
An FHA loan is a loan for, respectfully, people that are in a little bit of need. We have conventional loans that are, in my opinion, the best loans that you can possibly get if you can qualify for a conventional loan. Then you have FHA loans that were originally designed to give people access to purchasing a home with a really low down payment of 3.5%. Difference is that now that there are conventional loans that are at 3% or 5%, that kind of negates that, benefit. So what's left for the FHA loan is the ability of doing 3.5%, controlling mortgage insurance, and having lower credit scores.
So to start with, let's talk about the types of down payment that you can do using an FHA loan.
Yeah, so very similar to that of conventional loans, you're looking at checkings, savings, you can use stocks, you can also get gifts on FHAs, but gifts on FHA loans are a little bit different. The main difference is that with an FHA loan, you always have to source where the gift came from. So even if it's from a family member, we're gonna have to get a bank statement, the most recent bank statement from that donor or that family member to show that the funds were actually in their possession prior to being sent to you, regardless of whether they were sent directly to title or deposited into your account.
And as far as the amounts they can put down, what are kind of like the down payment ranges for an FHA loan?
Usually you don't see people go past 3.5% on FHA loans because there isn't a tremendous amount of benefit from doing so. The main reason is mortgage insurance. So what is it? Mortgage insurance is something that can come into play in pretty much every loan type that you are gonna pursue. On a conventional loan, mortgage insurance is required until you hit a 20% down payment or equity position with the home, meaning you own 20% of the home. So you don't have to have mortgage insurance if that is the case. If you put anything less than 20% down on a standard conventional loan, mortgage insurance is going to be required in one way or another. With an FHA loan, it's different. With an FHA loan, there is going to be mortgage insurance no matter what you do. There will be two types of mortgage insurance on an FHA loan. One of them is monthly, and the other is an upfront mortgage insurance premium that's actually added to your loan. That's equal to 1.75% of the loan amount. So there are trade-offs with FHA loans in that on the one hand, you're paying mortgage insurance whether you like it or not. But on the other hand, if you have lower credit, then your mortgage insurance is controlled. Because on an FHA loan, mortgage insurance is fixed at a certain percentage and cannot go past that. But on a conventional loan, the lower your credit score is, the worse your mortgage insurance is. So FHA does definitely provide a little bit of relief if you're talking to borrowers or clients that have a lower credit profile.
So real quick, a mortgage payment is basically made out of 5 different things. You've got principal and interest, you've got property taxes, insurance, and sometimes HOA. And in this case, PMI, the private mortgage insurance. If you're putting down less than 20% on any loan, you will always have the PMI or the private mortgage insurance. However, in this case, with an FHA loan, that private mortgage insurance never goes away unless you refinance to a conventional loan down the line. Let's talk about the types of properties that you can buy with an FHA loan.
When it comes to property types, FHA loans can be a little bit tricky. They're fine for single family residences. They can get really dicey with condos and townhomes because they have to be on a specific FHA approved loan list in order to be approved. And I think Daphne's favorites.
It's multifamily properties.
Right.
Okay, this actually really gets me super jazzed up, as you can see. So the reason I love FHA homes for multifamily properties, and I'm talking about like a duplex, triplex, fourplex, is because if you are looking to build your real estate portfolio, and this might be like the first home you're buying and you're investment minded, you can actually buy a multifamily property for 3.5% down instead of the standard 15 to 25% down. And you're actually buying the building. You're not buying like half of the duplex, which would be a townhome or a condo, which is a super valuable asset. So to give you kind of a real life example, let's say you find a duplex in like Round Rock, which is just north of Austin, or like Pflugerville, both really great areas to be investing in. And let's say the agreed sales price on it is $525, so $525,000, and you're putting down 3.5%. So the down payment for that home ends up being $18,375. So let's say you're an investor and buying this property with an investment loan, and the required down payment is 25%. You're looking at $131,250. That's like just over $100,000 difference to buy the same asset. So I'm a mega super duper fan of FHA loans to buy multifamily properties. If you want a multifamily property and you want to buy it with an FHA loan, call me up. I've been able to build my real estate portfolio that way, and I've been able to teach some other clients how to do that too. I think it's the best way to go. I love FHA for this reason and this reason only. Okay. Our next point, let's talk about DTI, or debt to income ratio, for an FHA loan.
So DTI is where FHA is really able to show a lot of its value to our clients or borrowers, in the sense that the debt to income limits are much more lax on an FHA loan. Whereas you're looking at somewhere around 45% on a conventional loan, upwards to around 48-ish. With the FHA loan, you could go all the way up to 55 sometimes on the higher end. So FHA loan just allows for a much larger debt to income profile and usually makes it much easier for clients to approve.
So on the note of DTI, I also want to bring up, back to the multifamily properties again, because I love them so much, that if you are buying, let's say, a duplex and your plan is to live on one side, the other half that is going to be rented out will be taken into account and basically taken off your debt, right?
Absolutely.
So can you kind of explain how that works?
Yeah, so essentially what we do is when we are sending an appraisal for this property, we're not just getting the value of the home, we're also getting comparables for the individual units and how much they would rent for. We're then able to count a certain percentage of rent for each one of the rooms, and we use that as potential income to offset the debts that are a part of the file. So it's often a lot easier to approve for that type of loan than you would think.
Yeah. So sometimes if you're qualified for like a lower amount and decide to go with a multifamily, you may have more buying power because somebody else is paying part of your mortgage, essentially.
Correct.
Generally speaking, the FHA loan is really perfect if you're looking to buy a multifamily property that you are looking to live in. That's actually a really important point. You do have to live in there for a while. You can't be an investor and get an FHA loan, put 3.5 down to buy this property. Your intention has to be to live there. I also want to say that because conventional loans are so comparable and have similar rates to FHA loans, a lot of times to buy a single family home, it just makes a lot more sense to go with a conventional loan. And I will say from my experience, generally FHA loans don't do as well in multiple offer situations, typically because they have the reputation of serving home buyers that have like maybe higher debt or lower credit, and it doesn't inspire a lot of confidence for the selling party to accept a buyer's loan if it's an FHA. Doesn't mean it never happens. It doesn't mean it's not a good loan. I think it's a wonderful product, but with Austin being the type of market that it is and home values going up so much, typically we see a lot of home buyers use conventional and jumbo loans. All right, the next loan, and I think one of the better options, is the VA loan, which is for veterans. Yay. Alejandro, what is a VA loan?
In my opinion, the VA loan is the best loan that is available anywhere for anyone. The amount of flexibility, the amount of benefit that, our clients and borrowers get from the VA loan is tremendous. But of course, you have to be a veteran. There are three main conditions that would allow us to provide a VA loan to a client. The first is that they have to have served at least 90 consecutive days during wartime. Another method is that they have to have served 181 days of active service during peacetime, or they have to have served 6 years of service in the National Guard or Reserve. But assuming all of that is in the right place, again, the VA loan is, in my opinion, number one.
It is. It's a really good program. Let's talk about the kind of down payments that we can do for a VA loan.
So VA entitlement is the first thing that you're going to hear people talk about when you're looking at a VA loan. And the entitlement is basically tied to the VA guarantee, which is in essence the mortgage insurance that you would normally pay on an FHA and conventional loan. What that VA guarantee is doing is essentially fronting you the money to the banks that you're borrowing from. They're telling them, hey, if this borrower defaults on the loan, we've got your back. We're gonna pay for this insurance so that you don't have to worry about this person defaulting. That's what allows borrowers that are using the VA loan to do as little as 0% down. How much of an entitlement they get varies based off of whether or not they own other properties that they've bought with the VA loan already. So what we do simply when we get a VA borrower is we request what's called a certificate of eligibility from the VA website, and it'll give us the data that we need to figure out, do they own other homes that are currently using the VA loan entitlement or not? And from there we determine whether or not the borrower has to put a down payment or not.
Now, I heard recently, and I don't know if this is true, that there's no limit on the VA amount.
That is really, really true and amazing. So this just happened, I want to say about 1.5 years ago, where they changed the guidelines. It used to be that the VA would insure, essentially, this is a little bit too complicated, so I'm not going to get too far into it. Essentially, they would insure and give you a $36,000 basic entitlement. But there was a bonus entitlement that essentially would cover 25% of the loan limit so that you wouldn't have to worry about mortgage insurance. Now, there is no percentage based off of the loan limit. Now they're guaranteeing or they're insuring based off of the sales price. So if you're buying $1 million house in an area where the loan limit is $700,000, they're not going to give you the VA guarantee based off of the loan limit in that area. Now they're going to give it to you based off of the actual sales price of the property, which means that you don't have to put a down payment at all.
That's really crazy.
On a VA loan.
That's awesome for veterans.
Yeah. The one caveat to that is us determining through that certificate of eligibility whether you've already used that entitlement on other properties. If you have, then there's a very strong likelihood that we are going to have to do a calculation to figure out how much precisely of a down payment you're going to have to put on this new house, since you already have use of the entitlement.
If you don't have VA and this doesn't make sense, don't worry about it because you don't qualify. If you do have VA eligibility, you probably already know what he's talking about. This is kind of more like intricate, like lingo explanations of things. But again, you'll probably understand it if you are eligible for a VA loan. I feel like most of my VA clients already know kind of what's going on with them, with their loan, what they're eligible for, and like how the process works. I think the VA does a really good job of educating veterans on their home ownership options.
Yeah.
Another question, what is a credit score requirement for a VA loan?
So with a VA loan, you're gonna see that most lenders across the board are looking at somewhere around a 620 minimum score. But I wanna advise you to make sure that you check. If you are looking at a lot of different lenders and trying to evaluate your options, confirm with that specific person, because there could be a lot of different overlays that would require that lender to ask you to have a higher credit score. So it kind of depends.
Okay.
In a comfortable place, I can tell you that with certainty, if you were at 640 and above, you'd probably be fine on a VA loan, but some will go as low as 620.
So that is it, guys. Thank you for watching all the way to the end. If you want more information on jumbo loans and conventional loans, please make sure to check out our other video about jumbo loans and conventional loans. That's all we got today. Would love to hear your questions. Leave a comment if there's something that we missed and that you want to know. Anyway, this is Alejandro Juarez.
Bye, everybody. If you have any questions or want to watch other videos, go to www.thejuarezgroup.com. Thank you.
And I'm Daphne Quay, your Boss Lady Realtor.
Bye.
Till next time.